All right, so tonight we're just going to quickly wrap up our discussion about the trinomial option pricing model. We were basically done with it last week. We went through the model. We looked at the theoretical underpinnings of it, and we showed what's most interesting about this model is the graph of the tree that results. And that third branch actually helps us in the sense that it not only provides more flexibility than the binomial option pricing model, but it means that the tree itself is follows a structure which much more easily lends itself to being stored in a matrix. With the binomial option pricing model, it can be done, but it's a little bit tricky because of the shape of the tree. But here you can see that as we move into the tree, this pattern is very regular. And so, for example, if you have a two-period model, at time 2, on the top row is x plus 2 delta x. Underneath it is x plus delta x, followed by x minus delta x, and x minus 2 delta x. One time step period previously, though, the values of the middle cells are the same. Well, what's missing is the top part because we haven't had time to reach the top or the bottom. So you can see if I were to increase this by one more step, what would happen is we'd have these same 5 cells here, plus x on the top, x plus 3 delta x, and at the bottom you'd have x minus 3 delta x. So it's a very predictable process. It's very easy to model as a matrix. And that's a huge deal. It makes things a lot simpler for us. And of course, just like with the binomial option pricing model, we're then going to turn this information into option prices. So we went ahead and started to do that down here. And just like with the binomial option pricing model, when we reach the maturity date, the option value is simply equal to the intrinsic or payoff value. Like here, I was using this as an example. Imagine we are at node FU, which means we've gone up once, and then we can reach 3 future nodes from there, FUU, FUM, and FUD, with the probabilities PU, PM, and PD. And so the value of the option at node FU is, as we've seen in the past, inside the brackets, we have the expected value of the option in one time step. What we've done is we've created a weighted average of the 3 nodes that we can reach in the next time step, weighted by the probabilities of reaching those nodes. This is all collectively known as the expected value of F in one time step. And then we discount that back 1 period because these 3 nodes occur 1 period in the future. And so that gives us a value for FU. Now, this is true for all the interior nodes. The terminal nodes that occur when we reach the maturity date will have the payoffs of the option instead. Okay, because that's the final day of trading for the option. And at that point, they are equal to their own intrinsic value or payoff. Now, as far as the American option goes, it turns out, interestingly enough, because of the way the tree is structured, we only have to make one change. Literally, one line has to be added to this code to turn it into an American option. So here, if you recall, we have this very complex nested loop where we filled in the tree for the options. Well, it turns out, if you look at the American code, which I have here somewhere, we need one more line to turn this into an American option, and that would be, let's see, it's right here. Yeah, here it is. This is it. This is the only thing we have to add. So you can see what's happening here is that we're saying, listen, once you've filled in this option price, this option price is based on the assumption that this is a European call option. If it's an American call option, what we have to do is say, well, listen, what would happen if we exercised at this node? We would have the payoff, and whichever of the 2 is greater is the value we'll assign to that node, because we're assuming that any time within the tree it makes sense to exercise early, we will do exactly that. So you can see the way it's written, application.max, where the word keyword application tells us that this is an Excel command. Fij is the value we calculated up here. This is the European value. And then we compare that with the payoff at that node. Okay. And whichever of the two is the greater is what we assign to that node. So this means value, if exercised early, and this means the value if not exercised early. And that's it. That's literally the only difference between the American and European models. It's pretty interesting. And that's again because of that wonderful structure of the tree makes it easier to update to become an American style option. Now, we did something like this with the binomial option pricing model, but it was a little bit messier. Here, because of the way the tree is set up, it's very easy to just say, well, listen, if this is an American option at each node, find out if it makes sense to exercise early. And then if it does, we'll assume that the investor will do so. Now, I did mention last time, there's a very interesting theoretical result when it comes to calls, and that is this. If the option is written on an asset that provides no cash flows, then it will never make sense, economic sense, to exercise an American call prior to the maturity date. In fact, let's see, maybe I could write that down somewhere just to make sure we don't lose this. So this is one of the interesting results from option pricing theory. With an American and European call, if the underlying asset provides no cash flows to the owner, it can be shown. And this is, by the way, you might remember that in the past when we demonstrated results with option pricing theory, we always did it by showing two portfolios and showing that the prices have to have the same value today if they provide the same cash flows in the future. And if not, an arbitrage would result. So this result I'm about to show you would also be proved in the same way. Okay, we can prove with no arbitrage argument that these two options will actually have the same value because there's no benefit to exercising the American option early. So it can be shown that the American option, or it will never make sense to exercise the American option early, or I should say prior to maturity. Therefore, the two options, American and European, will always have the same value. Now, part of the reason why this is happening is because recall that when an American option is exercised prior to maturity, the investor loses the option's time value, but gains the investment income that results from investing the proceeds of the option. Actually, what I should say, let's rephrase that, selling the underlying asset and then investing the proceeds at the risk-free rate of interest. Okay, so in other words, when you exercise it early, you lose all the time value, but what happens is you now have an asset in your hands that you can sell right away and use that to invest in, let's say, a treasury bill. And so if you look at how much you'll gain by doing that up until the maturity date of the option, we can show that it will never exceed the time value that was lost by exercising early. Now, having said that, though, if the asset does provide a cash flow. Um, well, actually, let me add one more thing here. If the asset provides no cash flows to the owner, the gain from investing the proceeds from the asset at the risk-free rate will never exceed the lost time value. So in other words, you've got the gain is the reinvestment income, the loss is the time value. And we can show that if there's no cash flows, then you're always going to be worse off because the time value will be greater than the reinvestment income. But, okay, so here we go. Here's the big but. If the asset does provide cash flows to the owner, then early exercise may make sense. And now here's why, because the time value is still lost, but the owner gains both the reinvestment income and the cash flow from the underlying asset. These cash flows may exceed the sacrificed time value of the option. So here it might happen, it might work. Another thing I want to mention here is that this is not true with the puts. Even if the underlying asset does not provide any cash flows, there will be some circumstances in which it makes sense to exercise an American put early. Therefore, its value will always exceed the corresponding European put. Now, it's way back in the previous class, we did have one chapter that had all these theoretical results. These two results were in there somewhere. We can go back and revisit these if we want to, just to show what portfolios you would set up to demonstrate these results. So, but we just want to be aware of this so that when we write our code and we see that the American option seems to have the same price, we don't want to wonder what's going on. Now, if you look here at the code for both the European and the American call that we've just been looking at, remember the asset that we're pricing is a option on a stock that sells for $100. The strike is 100. The option matures in 1 year. The risk-free rate is 6%. Now here we are assuming a dividend yield of 3%, a volatility of 20% per year, and 3 time steps. So I've opened up both the American and European code so we can look at them side by side. You notice that in spite of the fact that this one does have a cash flow, the two have the same price. Now, that's because there's only 3 time steps, right? When you only have the 3 time steps, there's always a chance that there will not be a single node in your tree at which it makes sense to exercise the option early. So what I'd like to do is show you a quick experiment. If we change this to, let's say, 50 and rerun it, we'll see if they deviate from each other. Let's see what happened. No, there's no. This one is 909,748. This is 909,749. All right, so it's not much of a difference, but you can see this indicates that somewhere in that tree there was at least one time when this American call was exercised early. Otherwise, the prices would be identical. Now, if you keep increasing the number of time steps, there should be a growing distance between the two because the number of nodes at which we exercise early will start to increase. And which is what you would expect. Now, for a model like this, 3 time steps is great for illustrating how it works, but it's not something you would normally see in practice. It's not 50 time steps isn't a whole lot of time steps, and it leaves a lot of potential inaccuracy in our model. So you normally run it with a lot more time steps, depending on how much computing power you have. But the idea here is that with the dividend yield here, you'll see that eventually, as you keep increasing N, the American coal will become more expensive than the European. But if you take this out, if you change this to 0, no matter how many time steps you have, the two of them will always have identical prices. Okay, so it's the kind of thing you can experiment with when you have code like this. But we can also show the theoretical reasonings why the lost time value will never be adequately compensated for with a gain of reinvestment income. Anyway, with all that being said, now this is true, by the way, no matter what model we're using, binomial, trinomial, it doesn't matter. These results are always the same. Black-Scholes, you name it. These are never going to be different. So, but anyway, so I don't think we need to really spend a whole lot more time with trinomial option pricing models because except for the puts where you just change the intrinsic values, like for example here, this is the European call that changes to a put. There's only one. Yeah, here it is. You just change this to K minus SJ, and that's literally the only change you would need. So in other words, all 4 of these cases, American and European call and put, are almost identical to each other, except for the intrinsic values and that extra line we added to the American call program. That's it. They're other than that, they're basically the same thing. Anyway, so now I think we're ready to have some fun with Monte Carlo simulation. But what I would like to do first, though, is mention that with Monte Carlo simulation, we've already discussed how it's really well suited for really horrifically complicated options, not so much these American and European style, because the lattice models work very well here. Okay, so let me add this here. So I mentioned this, I think, before, that one of the advantages of Monte Carlo simulation is that it requires little or no market data to be implemented. Okay. Now, this is especially advantageous for more complex options, which are sometimes known as exotic options, since these trade extremely infrequently. Okay, even the standard ones, the American call and put, European call and put, the so-called plain vanilla options, they don't trade anywhere near as often as, let's say, stocks do. Trade relatively infrequently. In fact, some options can go through an entire day or two without trading ever once. So that's actually a constant challenge with option pricing models, getting enough data. So that means that not needing data, or not very much, is quite a huge advantage. Okay, so that's one of the big deals. And by the way, why can we get away without having any market data? Monte Carlo is based on statistical models of the behavior of assets based on past experience. So essentially what you're saying is we think we know how this asset behaves, and we're going to model it like that. We're going to simulate its paths going forward so that we don't need market prices. Future paths for these assets are modeled using Carlo's simulation. And options are priced off of these paths. So let me show you a quick example of this. Suppose I'm trying to price an option on, let's say gold. Well, let's see. And let's say for some bizarre reason, I'm having trouble finding gold prices. Now, maybe that's not the best example because gold is easy. Let's try something else. Let's try zinc. Maybe zinc prices are not that, you know, you don't see them all the time. So what you're going to do is say, listen, we think we know how zinc behaves. So let's say today is the observed price of zinc. Call it S. And then here's time. And so based on the statistical model, um, we're going to simulate where does it go the next time step, which let's say is tomorrow. Then we'll simulate where it goes the next day. Then we'll simulate where it goes the next day. Then we'll figure out, we'll simulate where it goes the next day. Let's say that it matures, this option written on this zinc matures at time 5. So this is the price at time 5. We'll call it S5. And let's say this is the strike price, and this is a call. Well, that means that what this is saying is that the payoff at time 5 is S5 minus K. Now we don't need to worry about the max because we can see that it did finish above K. So on this path, the payoff is S5 minus K. So that means that the value of the option, if it follows that path to us today, is simply the present value of S5 minus K. Now, that's one path. Now, of course, we wouldn't be so foolish to think that that's definitely going to happen in the future. This is one possible path that it can take. What do? Is we do this again so that we have two paths. And of course, each of these paths will be different. Something like that. All right, my drawing is getting a little awkward here, but you get the idea that, so think of this as path 1, and this is path 2. Now, clearly, the options price is very different on the two paths. So what do we do here? We average them out. So the option price today is the present value of this average payoff. Now, again, it's going to be hard to have a lot of confidence in a simulation that has two paths. What we're trying to do with these paths is basically create a probability distribution for the future value of this zinc. Okay, so what's going to keep happening is we're going to keep increasing the number of paths. Before you know it, you've got all these paths going along here. And what you're creating is a probability distribution, some kind of a density function. Will follow the log normal distribution. So you're going to get a bunch of values that look something like this if you do enough of them. And so then you're going to calculate the option price from the center of this distribution or the average. So let's say we call this ST bar. So then the option price today, assuming that, let's say it's a call, would be the present value of max ST minus K0. So in other words, you're not comparing a single stock price to the K, you're comparing the average of all those paths. And whatever that number is, the present value today is our simulated option price. Yeah, so in other words, now this raises a lot of interesting questions like how do we generate the paths? What are we basing our assumptions on? How often do we have to do this to get a realistic result? Well, it turns out that we can actually calculate a confidence interval for our results that'll give us a sense of how close we are likely to be to the true price of this option. And we often check our model on a Black-Scholes price, so we can compare our results with the actual Black-Scholes price. So in other words, we'll start by doing a European call option that whose Black-Scholes price is known, and we'll run these paths, and we're going to see how close we're getting to the true Black-Scholes price. Now, of course, because this is a simulation, we're never going to get it precisely right. We're going to get a range of values, but if there's some tolerance that we're willing to put up with, let's say it's okay to get within a penny of the true Black-Scholes price, that might be good enough. And so we want to know roughly how long will it take to get to that point? Will it take 10 paths? Will it take 50 paths, 100, 1,000, a million? And then we can go ahead and run our simulations. And we also will, another reason for comparing our results to Black-Scholes is to make sure that everything's working correctly. If not, if we keep finding ourselves consistently too high or too low, then we may be making incorrect assumptions. Okay. So there's a lot going on behind the scenes here. But in a nutshell, we are simulating paths. Now, by the way, when we say simulate, simulation itself is based on our ability to generate what are called random numbers. Now, by the way, this is interesting. Excel does have a random number generator, which means we can borrow it in Excel, VBA rather. So in other words, the paths are generated by using random numbers, which are substituted into a statistical model, which is thought to govern behavior of this asset. So no, there's a lot going on here. We have to take a step back and explain these as we go along. There's many different kinds of random numbers we could potentially use. There's certain properties though that we would like to see in these random numbers. And there's also efficiency considerations too, because we may need literally millions of paths to get to a reasonably good answer. I think I mentioned once before that this is one of the holdups with Monte Carlo, that it's unbelievably time consuming. And so we tend to reserve it for cases like exotic options, because it would be kind of overkill to use it for certainly European options. I mean, you'd be crazy to use it for that, because you could just throw numbers into Black-Scholes. It turns out too that it doesn't work particularly well with American options. So Monte Carlo would take too much time to be practical or use with when to use for pricing European options. It also is very difficult to adapt to American options because of the early exercise feature. You notice how, like with the lattice models that we've been using, what we're actually doing, whether it's trinomial or binomial, is we're basically assuming that we have the ability to go into the future and work our way back to the present. So, um, so once again, just a quick reminder that if this is a two-period call option model, these are the payoffs or intrinsic values. And then, of course, the interior nodes, we use the technique we were just looking at a few minutes ago. FU, for example, would be the present value of P times FUU plus 1 minus P FUD. FD would be the present value of P FUD plus 1 minus P FDD. The price today, F, would be, again, the present value of going up to FU or down to FD. But in other words, we're actually taking it out, going out into the future and working our way back to the present when we can convert this into an American style option, because we're assuming that we have to be able to look ahead to see if it makes sense to exercise the option early. So in other words, these are the European prices. With the American prices, FU is the max of this expression. And of course, this at the end there, you've got the American value if exercised. And this is the value if not exercised. And of course, the same thing is true for FD. And then for today, it would be so there, we're assuming that we're able to look ahead into the future when we make these decisions about whether to exercise or not. Now, that's fine for a lattice model, but for these Monte Carlo models, you notice how we're saying that we've got an asset like a stock, let's say, and we have a statistical model that tells us how it changes over time. And so we follow it along and we simulate it, but we can't, for example, stop here and say, well, should we exercise early or not? It doesn't, we don't have that capability, or at least doing this would be horrifically complicated. And I've actually seen papers where they try to explain how this is done, and they're really terrifying. So typically we reserve, like I said, Monte Carlo for these very special exotic options. And what really makes it work for them is this. So Monte Carlo simulation is normally reserved for exotic options. In many of these cases, value of the option um, depends on not just value of asset on the maturity date, but the path followed up to that point in time. When this happens, the option is said to be path dependent. Okay, so let me show you a quick example of this, and we'll go ahead and look at some more of these. But here's one that's very straightforward. For example, an Asian option is a hybrid between a call and a put, where it can be exercised. I'm sorry, it's a hybrid. I shouldn't have said that. It's a hybrid between a European and an American option. It can be exercised uh, multiple points during its lifetime, which are specified in advance. But in others, if you notice, unlike the European option where you have to wait to the maturity date, or the American option where you can exercise anytime you please, this one says on certain dates you may exercise it, and that's it. So, and then here's the even more interesting part. The final payoff of the Asian option is the average of its payoff at each of the on each of the dates at which it may be exercised. Well, actually, even then, I probably shouldn't. I think I'm going to change the way I've described this. It's a little deceiving. Let me try that one more time. Let me think about it a little bit. It's a hybrid in the sense that it is not exercised prior to maturity. Okay, so I've done this very badly. It at multiple points during the lifetime of this option, its payoff or intrinsic value is calculated. The payoff at maturity is an average of these payoffs. All right, let me show you an example. It'll be so much easier. Let's say that we have this case, and here's an Asian call. It's written on gold, let's say, and it matures in, let's say, 4 months. The strike price is, let's say, $2,000. The payoff is determined. One in 1 month, 2 months, and 3 months. All right. Okay, here we go. So this is what's going on. So let me draw you a little graph. So what we're going to do is see that Here's the gold. And here's today, here's time, 1 month, 2 months, 3 months, and 4 months in the future. Here's the current gold price. Let's say in right here, here's the gold price. We'll call this S1. So the payoff here is just, what you would expect it to be since it's a call. And then here it comes down. Oh, here we go. It's down to S2. And then at time 3, it's going up here. And then it ends up here, let's say. Let's just say for simplicity, the strike price is here. Now you notice on the final day of trading, the gold price is actually under the strike price. So if this had been a European call option, it would expire out of the money. It would be worthless. But here it doesn't matter because what's going to happen is the payoff at time 4, the actually I'll need a lot more room than that. Hold on a second. Uh-huh. So you see now what's happening is that we're averaging out the payoffs at those 3 time steps. Whatever that number is, that's the payoff. And now the price of the option would be the present value of that. So today's price, and this is true for all option pricing models, is the present value of the future payoff. Now, so here's the thing. If you notice that it makes almost no difference. I mean, the way I've structured this, it makes no difference where the gold price is at the maturity date. All that matters is those 3 intermediate steps in between. The average payoff of those 3 dates is what we're after. So this, because of the fact that the payoff to this option is not based on the final price of the gold versus the strike. Instead, it's based on the entire path followed by the gold up to that point. It is said to be a path-dependent option. By the way, there's more than one way to structure an Asian option. This is just one way it can be done. This Asian call option is said to be path-dependent since its value depends on the evolution of the gold price over the lifetime of the option. Okay, now here's a good question. Why would you want something like this? An Asian option is a good, is often used to hedge multiple exposures. to an asset. Like, for example, let's say you're a jeweler and you're constantly buying gold. Okay, let's say for whatever reason you need to buy gold every month for your business, and you could then buy a call option for every one of those dates, but that could get terribly expensive. What you're basically essentially doing here is you're hedging the average price of gold over that interval. So we're used to hedge multiple exposures to an asset without paying an exorbitant cost. This hedge provides a hedge of the average gold price during the cycle. Now, all these exotic options, by the way, they have one thing in common. They are um, traded in the over-the-counter market, which means they're negotiated directly between counterparties. Okay. In other words, if I need this, I'm a company that needs an Asian option. I'm not going to find it in the Chicago Mercantile Exchange. It's too specific to my needs. It's much too narrowly focused. I will call up, let's say, a major investment bank like JP Morgan Chase and say, listen, I need this exotic option. I need this Asian option. And then they'll quote me a price and I'll agree or not agree to buy it, depending on how expensive it is. But it's just an agreement between myself and my counterparty. And so at the end, the payoffs that I earn are coming out of the pocket of the seller of this option. And by the way, this is where the math can get really hardcore, where the investment bank is going to have a team of quants and they're going to sit down and try to figure out what price this should be selling for. And that's how they come up with a quote, because there is no market price to look at. So they'll just say, well, based on what we see here, it should be worth $100 or whatever. And then the customer can decide if they want to buy it or not. But this is a good example of why, when you want to use Monte Carlo simulation, I mean, how do you know that this option is worth $100? You probably are going to end up using Monte Carlo simulation. There really is no other approach that would make sense. And so that would be based on your beliefs about the way gold prices change over time. And you hopefully have statistical models that are better than your competitors to do this. And so once you have that information, you can run these massive simulations and come up with a number that you can give to your client and say, listen, this is how much we charge. This would be a real headache. Imagine trying to do this with a binomial or a trinomial model. It's just not going to happen. Okay, it couldn't. It's not that it can't happen, but the problem with those is that you're restricted to where the prices can go. You can only have so many branches on that model, but here it's easier to show the path deviating and bouncing around and going up and going down. And again, the issue too is that you're not going to be able to look in the Wall Street Journal and get Asian option prices to use to model them. So the prices almost are impossible to find. So what do we do instead? We use Monte Carlo simulation, because here all we really need is not Asian option prices. We just need to be able to simulate the price of the gold, and then we figure out the rest. So, this is kind of like an introduction to when and how you might want to use Monte Carlo, as opposed to what we were doing before with the lattice models. And you can see each approach, each model is designed for a different type of situation. And so you will, of course, use the one that makes the most sense. But again, the Monte Carlo is hampered by the fact that it's just so terribly time consuming. But for certain assets, this is really the only option you have. Now, having said that, though, I'll put this in parentheses. There do exist models that attempt to, in effect, act like a Black-Scholes model, determine the prices of American and exotic options with a closed form model, meaning that you just plug in the numbers and you get your result. Now, how well they work is a separate question, but they do have them. I mean, they're out there. If you look up, like there's a book that you can buy, which I actually happen to have a copy of it right here. Um, it's called go get it off my shelf. I forgot the exact title. Ah, there it is. There it is. Now this book has been around forever. You can see he hasn't updated it in like 17 years. But basically it's just an encyclopedia. Like every page, here's a formula that you could potentially use for an Asian option, for example. And interestingly enough, the code is all written in VBA. But the goal is to say, listen, if you don't have the time to run a very complex Monte Carlo simulation, this model will give you a number that could do a pretty good job. It might be close enough for what you're trying to do. And so this book, which I do have, like I said, and I've never tried to really go through and prove, because I don't really have access to the information I would need to do that, to say, well, listen, how well do these models really work? You know, if I worked at like JP Morgan Chase in the research department, or if, you know, it's possible that this could be done, but I don't have access to that information. Um, and to run through and do a full study to see how well these models really work, but they do exist. They're out there. Okay, so but normally if your company has the resources it needs, it would try to do a proper Monte Carlo simulation because that's most likely to get you your correct result. Okay. So, in other words, it's got to be difficult. At least with our binomial and trinomial option pricing trees, we can compare our results to Black-Scholes to see if they're working correctly. We don't have that luxury here. We're creating theoretical models and we're trying to come up with the best possible price. Okay. Now, having said that, though, you can at least try to use these to see how well they perform on Black-Scholes. But again, you're going to have to run a lot of paths to get even reasonably close to the Black-Scholes model. But for options that don't trade very often, for assets that don't trade, it's something to at least think about. So now what we have to do is sort of take a step or delve into how the actual simulation works, specifically how to generate random numbers. And it turns out, like I said, Excel does have these built into it, which we can lean on for VBA code. But we want to understand what's going on behind the scenes. How is this being done? And how do we know that the results really follow the distribution we're asking for? For example, a lot of random number simulators or generators like the ones in Excel, you might think that they're simulating the normal distribution, but they're not. Let's say I want to know a random number between, let's say, 1 and 100. Well, Excel has that, but there's an implicit assumption here that each of these numbers that I'm choosing from is equally likely to be chosen. So in other words, what you're seeing here is actually the so-called uniform distribution, the discrete uniform distribution. Now, you can also ask it for uh, the continuous uniform distribution, where you're looking for a number between 0 and 1, but just type in rand with no argument. And so you'll see whatever number you get, it'll always be between 0 and 1. If you do this enough times, you'll see that you're getting the same number within each range. And that's by design. And now you might say, well, how is this helping us? We don't, we want to simulate, let's say, the normal distribution. It turns out we're going to see how this is done, is that the continuous uniform distribution defined over the interval 0, 1, which is known as the standard uniform distribution, can actually be used to simulate from any probability of distribution. In other words, I can use that as the starting point for simulating normal random variables. That's interesting because that's what's built into Excel. Now, by the way, this is why they did it this way. It chose the rand function to allow us to simulate from the continuous uniform rather than, let's say, normal, because then if we know what we're doing, we can use that to generate all the rest of them. Okay, and we're going to see exactly how that works. But let me show you a helpful insight here. Let's say that, you just want a quick result. In Excel, if you may have noticed that you have available to you on the data tab, if you've installed it, something called the data analysis tool pack. If not, you can install it yourself from over here, the options menu. And when you do that, you've got to tell it you are interested in add-ins, go button, and then you just click on the one you want. It'll magically appear in your data tab. So when you go to pick it, you scroll through the list of functions it has. Right here, random number generation. Let's say I want to simulate 100 random numbers chosen from the normal distribution. Mean 0, standard deviation 1. And here we go. There they are. Now, if I turn these into a plot, you'd see that they should look approximately normal, or they would if I have enough of them. So, it's already there, but we want to understand how that was done. Okay. Although we're ultimately going to end up using the normal distribution, we want to know how to go from the continuous uniform into standard normal. And so we're going to do exactly that, but not tonight. Okay, right now, I think we'll knock it off right here. And then next time we can go full steam ahead into Monte Carlo simulation. And I think you'll find it, like I said, to be very interesting. We can do a lot of things with it. We're going to do some experiments. We're going to try different numbers of simulations to see how accurate the prices are, and so it'll be a lot of fun. So anyway, I'll see you next time then.